Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week's episode is number 75. And this week on the podcast, I wanted to cover a topic that's been in the news quite a bit this week, and that's President Biden's proposal to eliminate preferenced long-term capital gains tax rates and eliminate the step-up in basis. If you don't know what I'm talking about, listen on because I will explain these concepts in detail and how it impacts you. If you have heard of these concepts, you might know that this could have far-reaching implications for the way we plan to bequeath assets to our kids and other beneficiaries. And if you're a small business owner, this absolutely impacts you because the tax that you pay if you sell a business could be dramatically changed if this proposal is passed in its current form. So I explain these concepts in a lot of detail in this week's episode, as well as a couple planning opportunities that I see today based on the proposals as we have them now. I hope you enjoy it. Okay, so we are now I'm recording this, it's the very last day in April 30th. This episode will be published at the very beginning of May, and we have just passed, I believe we're right around the threshold of Biden's first 100 days in office. And so he's done a lot of stuff, and as I've talked about on past episodes of the show here, Biden communicated his tax plan here sometime around last summer as the campaign season really started kicking up, and so we had some idea of what he wanted to do. We know definitively that federal spending will probably go up pretty substantially. That's already been the case with some of these stimulus packages that have gone through with Biden in office compared to Trump, I guess. And the question really is, how is he going to pay for it? Or the question that a lot of people are asking is, how is he going to pay for it? And so his tax plan has come under a lot of, I don't want to say scrutiny, but it's something that's been very interesting to a lot of people around the country. And in general, I think the takeaway from what he has communicated up until this week in his tax plan was that he wants to tax the rich a little bit more than we were. And the details of his tax plan were such that if you're making less than $400,000 a year, you're probably not going to pay any more in tax. Corporations would probably see a higher tax rate. And so now we're in the tail end, we're right around this 100-day threshold, which is, the first period where the president has maybe the greatest opportunity to enact change. He's fresh, he's new. That's when a lot of the big stuff gets done. And with the fight against COVID and a lot of other things going on, we kind of knew that a change to the tax code would happen sometime. We just weren't really sure when that might happen because obviously with COVID, it has not been at the top of the priority list for the Biden administration to work on. So now the first 100 days have just lapsed. We are distributing vaccines, and some of those other fires he had to put out initially are kind of in hand. He's done the work he's going to do on those issues. Now it's time to come back to taxes. And so this week, if you have not caught any of the news cycle at all, there was an announcement by his administration, and I think he probably talked about the details in his address to Congress this week, although I didn't watch it myself, that part of the tax plan he'd like to push is a change to the long-term capital gains tax rate for people making more than, I think it's $400,000, but it might be $1 million. I can't recall off the top of my head. And he wants to remove the step up in basis that we enjoy, that our assets, that our states enjoy upon our death. Those are two pretty substantial changes, and they have far-reaching impact for financial planning, for estate planning, and certainly for small business owners. And because this is a show to help business owners align their wealth with their values and reach a better financial destination for them, I felt like it was pretty important for us to cover this week because of the potential impact should this be passed. So I'm going to cover kind of contemporary, planning thinking, at least from a practitioner standpoint, around both of these topics, and then the potential implications if they were to be changed in the way that's been proposed. So let's start with the long-term capital gains tax rate. So as things stand, if you own an investment, let's say that you buy 100 shares of Apple, and then the value of those shares goes up by $100. If you sold those shares of Apple and take that $100 gain, that $100 is going to be taxed at your ordinary income tax rate. Based on how much you make, that depends, or that determines what bracket you're in. So if you were in the 12% tax bracket based on your taxable income, you're going to owe the federal government $12 out of that 100 that you just made. And if you're in the 35% tax bracket, you're going to owe the federal government 35%. Well, those are short-term capital gains. And in the tax code, we have long-term capital gains at lower rates on investments held for longer than 1 year. So let's say same situation, you buy some Apple, it goes up by $100, and then the value doesn't move at all. And you hang on to the Apple shares, and on day 366, so you've held those shares for over a year, the value is still $100 more than what you paid for it, which is also called your cost basis. Well, you still have the same $100 gain that you did on day one of the transaction. But as soon as you hold an asset for longer than a year, that's when these long-term capital gains tax rates kick in. And currently, you can pay 0% on long-term capital gains if you're under a certain threshold, or 15% or 20%. Now, for higher income people, the Affordable Care Act surcharge also comes into play here. And so currently the top tax rate that you pay on long-term capital gains is 23.8%. And so this is really, really convenient for investors, for professional investors, the mutual funds, institutions, hedge funds. It's very convenient for business owners. The planning around this allows you to, or enables you to pay a lot less in tax. Because think of the alternative. You're talking about the top tax rate, which is currently 37%. It goes down to 20% if you hold the asset for at least a year. And so it's not that much money if you're talking about a $100 gain in your Apple stock. But if you're talking about the sale of your business that has maybe $10 million of revenue and a couple $1 million of earnings before interest, taxes, depreciation, amortization, EBITDA, I mean, that's a substantial amount of money that you would be paying extra if that rate went from 20% up to over 40%. So, and I skipped over that part, but that's what Biden is proposing, is to change that long-term capital gains tax rate from 20% or 23.8 up to 43.4%. So that's a substantial hike. Now, it's not going to be applied to everybody. There is an income threshold here, and I should have looked it up before hitting record on the episode, but it's Friday, it's been a long week, and I'm a little bit tired, so I didn't do it. But it's either $400,000 or $1 million of taxable income. So if you're making a couple $100,000 a year and you're maybe harvesting long-term gains on like company stock, if you work at like Apple or Facebook or something like that, or Google, you can do that in a way where the current long-term tax rate is still preserved, and you just make sure that your taxable income doesn't exceed whatever that threshold is for the year. But whether that threshold is $400,000 or $1 million, for a small business owner with a little bit of equity and value in the equity of their business, you're probably going to be north of that if you have something that's worth selling. It's pretty easy to blow through $1 million of capital gains, especially when you have assets in your business that you depreciate down over time for the year-to-year tax savings. So you can see where I'm getting at here. This is a big deal. Around a 20% hike on gains on assets that have been held for longer than 1 year. And I'm in California, for example. California has a top tax rate of 12.3%, and there's an extra 1% mental health surcharge on there too. And so we're looking at total all-in tax rate, if you're in the highest bracket, of, I think it's 56%, if I'm doing the math in my head right. And that's a heck of a lot of tax to pay on the sale of a hard-earned business. Now, when you go through a sale of a business, there are a couple different ways to structure it. You can sell the assets of a business in an asset sale. You can sell the stock of the business in a stock sale. Really, the structure of the deal doesn't matter a whole lot, because chances are you've held that asset for longer than a year, and this jump in the long-term gains rate is going to apply to you regardless of what that structure is. So the planning opportunity here, number one, obviously, if you're thinking about selling your business in the next couple of years, now might be a pretty good time. We have no idea how this is going to play out. As always, these are just rumors. This is what Biden has proposed. It has to go through the legislative process. Who knows what changes we might actually see. And on top of that, whereas most of the time when we have tax law changes like this, it's proposed by the president. It goes through this process. There's all this horse trading that goes on amongst legislators. You do this, and I'll give you this other thing that you want. There are just political favors that are traded all over the place, and I don't fully understand how all of that works, to be totally honest. But the current proposal might end up being radically different in form by the time it's actually written into law. Usually, when this stuff happens, aside from the fact that the end product might be different than the initial proposal, aside from all that, usually when this stuff is passed, it doesn't become active until the following year. But that's not always the case. Most of the time, that's how it works. But it's possible that this thing goes through the legislative process, and then we come out with a bill that says, all capital gains as of January 1 of 2021 are subject to this new tax rate. Which means that if you're thinking about buying a business, selling a business, and maybe some point in the next couple of years, and you're hearing all this noise about the long-term cap gains rate going up, it might make sense to hurry up and get a deal done by the end of December. But it's not impossible that this is made retroactive to January 1st of this year. And that would be pretty frustrating if you rushed to get a deal done, maybe before you were otherwise prepared or really wanted to do that just for the tax savings, and then it turns out to be a moot point. So that's generally how it works, but there's no guarantees. There are no promises that that'll be the cycle this time. The other opportunity that is probably more realistic for most business owners who are thinking about selling at any point is to do what's called an installment sale. And we're going to have a guest on the podcast here coming up a week or two from now who's an M&A specialist. And I will write this down to ask about this with regard to the potential long-term cap gains rate going up. But rather than selling 100% of your business on the dotted line and then just walking away and being good, you can sell a portion of it over a series of years. And that can make a lot of sense because it just allows you to spread out the tax ramifications over a few years. So let's say, for example, the threshold for this increased long-term cap gains rate is $1 million. Well, I take it back. Let's make it the $400,000. And I wish that I had looked it up, but I didn't. So here we are. Well, if you sell your business on day one and it's worth like $1.5 million, you're going to blow through that threshold, and the vast majority of that gain, pretty much all of it, I believe, will be subject to that 43.4% rate. But if instead you decided to sell 1/5 every single year for 5 years, then you're only going to have $300,000 of deal value each year for 5 years, which may indeed keep you under that threshold, depending on other income sources you have coming in. So there are certain ways that kind of deal has to be structured to enjoy that kind of taxation. Oftentimes, deals will be structured to where the ultimate sale price depends on revenue or EBITDA or profit margin in the years after the beginning of the sale. So it kind of incentivizes outgoing sellers to stick around and, be a good steward of the business and make sure that the new ownership is able to maintain cash flow and profit streams and so forth. And that's a really mutually beneficial way to do it. But as we sit here thinking about the possibility of long-term cap gains rates going up, it just screams to me that installment sales would be an excellent fit to navigate around that problem for a lot of people out there. Now, if you've got a business worth $50 million, you're going to have to live a long time to spread out a deal for long enough to get you under the threshold. You're probably going to pay that higher rate either way. But for someone with a business worth, I don't know, maybe 1 to 7 or 8 million off the top of my head, perhaps that could start making a lot of sense. And of course, it depends on what your basis is too. I mean, I'm assuming that the assets in the business have been depreciated down by enough to where the majority of that deal value is considered long-term capital gains, which is not always the case. So that's the deal with this long-term capital gains rate. In investment management and investment planning, this comes into play a lot too. I mean, we have a lot of clients that come in with a bunch of shares of a specific mutual fund or a specific stock. Some of it they've held for a short period of time. Some of it they've held for a long period of time. And tax planning number 101 is to, if we decide to liquidate that position due to concentration risk or because there are other alternatives that would be a better fit for the portfolio, we want to sell those appreciated assets in a way that captures the long-term capital gains tax rate. And if this is passed in its current form, that kind of throws that ideology on its head, or strategy, I should say, on its head. And of course, we'll wait for the law to come out and then come up with another strategy and way to handle it. But depending on how this thing goes, I could easily see myself suggesting to people that we harvest some of these long-term capital gains this year, as opposed to waiting around for the rates to go up. So if that's you, talk to your tax person, talk to your advisor, your planner, whoever you're working with, because being on top of the stuff this year could prove beneficial down the road. Now, on to the step up in basis. So back to our Apple example, you buy shares of Apple for $500, they go up by $100 to $600. Whatever you buy the shares for is your basis. And so if you sell the shares for $600, you're not paying capital gains, regardless of whether it's long-term or short-term. That only depends on how long you've held it. You're not paying capital gains on the entire $600 because you paid $500 for it. That's your cost. All you're paying tax on is the growth, or $600 minus $500, which is $100. Now, that basis is stepped up when we die, which means that if I have a taxable brokerage account in my name or in the name of my trust or anything else that's not a qualified retirement or health savings account or something like that doesn't enjoy any other kind of tax preference. If I buy $500 of Apple today and then I die tomorrow when the shares of Apple are $600, my beneficiaries enjoy a step up in basis, meaning that on the day that I die, let's say tomorrow when the shares are worth $600, that establishes the basis for my beneficiaries. And this is a huge tax planning tool that planners, estate planners, lawyers, accountants use across the board to minimize tax impact and promote multi-generational wealth. Because think of the alternative. I mean, I've heard this story over and over and over again where someone had parents who were really forward thinking and bought like 100 shares of, I don't know, GE like 50 or 60 years ago. And then they never did anything with it. They just bought the stock and sat on it. They held like, physical certificates or something that sat in a safe in their house. And, mom and dad just bought the shares and then just never thought anything about it. And then years and years and years and years later, they remember that they had bought the shares and now it's up like 10,000% or something just astronomical. Well, that's a big deal because if the shares are now worth $50,000 and you paid $200 for them, if you sold them for $50,000, 99% of that value is going to be subject to long-term capital gains tax. And so if your mom and dad trying to figure out what the heck to do with these shares, you could sell them and pay the tax if you need the cash, or you could hang on to them because once you pass, if your kids or whomever inherits the stock from you is going to enjoy a step up in basis from $200 all the way to $50,000 or whatever the value is on at your time of death. So with that in mind, when people inherit investments, taxable investments from anybody else, they have the ability to, and the freedom really, to sell those investments however they like because there's not very much tax impact to it because of that step up in basis. So that thinking is a really pivotal part about of multi-generational wealth planning and deciding on what to do with some of these long-held assets. Now, part of Biden's proposal, and this threshold I'm a little bit more confident in, thankfully, is that if you have assets in your state of less than $1 million, your beneficiaries will enjoy that step up in basis. Or in other words, the first $1 million of assets in your estate enjoy a step up in basis. But beyond that, there is no step up in basis. This is the proposal, mind you. This is not a bona fide change in the tax law. And so that's a huge departure of the way that from the way that the tax code exists right now. And so, whereas if the kids inherit some stock today, ordinarily we want to sell that stock or whatever that asset is pretty soon after inheriting it, because when you do it at that point, there's not very much tax impact. And you free up the cash, and it gives you the ability to rotate into a portfolio that's a good fit for you, as opposed to the assets that you inherited being a good fit for your parents. If that goes away, then there's going to be a lot of people out there who will not want to sell assets that they inherit because they do not enjoy a step up in basis. They're going to owe a large amount of tax. And for business owners, this has the potential to be really disruptive to business owners, because a lot of times in closely held family businesses, this step up in basis is a primary tool to avoid any kind of capital gains tax for the rest of the family. The founder of the business starts a business, grows throughout their lifetime. It's a family business. Kids are going to step into the management fold and take over at some point. Well, if mom and dad sell to the kids, that's a taxable event and adds a lot of tax liability to the entire family. But if you bring the kids into the fold and they inherit the business from you, then they enjoy that step up in basis too, just like they would a stock, whether it be GE or any other asset. So taking that away means that it just adds to the tax bill down the road for other people. And there's going to have to be some other kind of planning device or some other strategy that's included in the long-term family tax plan to allow somebody in the family down the road access to some of the equity in that. And again, maybe an installment sale is helpful there while mom and dad are living. This is another opportunity for trusts too. I mentioned trusts in the sense of a living trust, but an irrevocable trust allows you to put assets into it and have tax implications basically set on the day that you fund the trust, as opposed to including all the future growth. And I kind of butchered that description, but if you have a business that's worth $1 million now, you think it's going to be worth $5 million in 15 years. Well, if you put the business into a trust now, you're sealing the amount of tax you pay based on the $1 million value today. And all that future growth between $1 and $5 million would be, you wouldn't be responsible for that. The trust would. And so there are a lot of planning techniques and opportunities for closely held businesses that take advantage of that kind of stuff. And if the step up in basis goes away, that might be a good opportunity too, alongside an installment sale. So the step up in basis, it's a big thing. And off the cuff, if you're someone who has an estate plan and are expecting to use that step up in basis for the benefit of your beneficiaries, whether they be your kids or whomever, I think what you would probably want to do is compare your tax situation to those of your beneficiaries if this proposal goes through and the step up is removed. Because if you're in the 37% bracket now, and your kids are going to inherit everything from you, and they're in the 12% or the 22% bracket, well, you might not want to sell anything at the moment because based on whatever this long-term capital gains threshold is, you will probably end up paying more in tax than your kids would if they sold the asset after inheriting it from you. So there's some strategy and some calculus in this. Every situation is a little bit different, but that's basically, thought number one is, well, just compare the tax liability of you selling versus the tax liability of your beneficiary selling after they inherit the asset from you. You can also gift while you're alive. That might be another option. And then the recipient of the gift sells. The only thing I can think of where this would not make sense is if your plan is to give it all to charity or whatever you're giving to charity. Don't sell anything while you're alive that's going to wind up at a charity anyway. Because if the charity receives an inheritance from you, or a gift or grant or whatever the form of structure is, they're not going to pay tax on the gains of selling it. Whether they get the step up in basis or not, given their status as theoretically a qualified 501c3. So those are just a couple thoughts. Like all this stuff, I don't like to read too far into this on day one. I like to wait for the legislative process to resolve itself and then rely on people a lot closer to this and a lot smarter than I am and hear what they have to say with regard to important takeaways, what the changes are, and what the planning opportunities will be. But suffice it to say, we expected some tax changes from Biden, and that's absolutely playing out. And I would expect that we're going to hear about a lot more here in the next 4 to 6 weeks. So what actually ends up becoming law, who knows? but it's something to keep our eye on. And I can assure you that we'll have another episode on this subject later in the year if and when this stuff actually becomes law, with some real concrete planning opportunities based on the outcome. So that's it for this week. I hope I didn't dive too much into tax stuff and just bore the heck out of everybody, but it's important. It absolutely is important. If your intention is to squeeze as much out of your assets as you can, build multi-generational wealth, these are two really, really commonly applied tax planning tools. And if they change, it throws a lot of tax and estate planning on its head. Okay, that's it for now. Have a good week. I'll talk to you all soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.